Welcome to today's market report. Wall Street stocks finished lower while bond yields and the dollar rose on Thursday as investors worried about the potential for aggressive US policy tightening as other central banks around the world moved to reduce support. The benchmark 10-year US Treasury yield jumped following 2 days of declines after a flurry of US economic data such as retail sales and jobless claims, and the European Central Bank's announcement of less aggressive than expected tightening plans. New York Fed President John Williams said on Thursday that the U.S. Federal Reserve should reasonably consider raising interest rates by a 0.5 percentage point at its next meeting in May, which was seen as a further sign that even more cautious policymakers are on board with bigger rate hikes. This was after the ECB said it plans to cut bond purchases, known as quantitative easing, this quarter, then end them at some point in the third quarter. Investors also eyed hefty rate hikes by New Zealand's Central Bank and Bank of Canada, and a surprise rate hike by the Bank of Korea, as well as policy tightening by the Monetary Authority of Singapore. These moves all exacerbated bond yield increases and stock price declines. US stocks had gained on Wednesday on hopes that price increases could be peaking, but investors saw Thursday's trading action as a sign that there was little conviction behind those hopes. The Dow Jones fell 0.33%, the S&P lost 1.21%, the Nasdaq fell 2.14%, the Pan-European Stock 600 index rose 0.67%, and MSCI shared 0.71%. GBP/USD, which nearly changed hands as high as the 131.50 mark earlier in the day, has now reversed lower to the 130.80 area as the pound weakens in tandem with the euro post-dovish ECB policy announcement. Eurodollar plummeted to 107.65, its lowest in 2 years, following the ECB decision of keeping rates on hold as widely anticipated, and repeated that it would end its bond buying program in the third quarter. This is today's market news. Thanks for listening. We'll see you next time.